Hello everyone, this video, we'll explore a recent analysis from a news source on the potential role of the U.S. Treasury and banks in an Iraqi dinar exchange process. According to the report, when people in the U.S. go to exchange their dinars at banks, the U.S. Treasury is expected to be the primary funding source for these initial exchanges. Rather than banks needing immediate cash reserves to cover the transactions, the Treasury will back them electronically. This approach creates a more secure and efficient system for both banks and individuals, ensuring there's enough liquidity to manage high demand if large numbers of people participate in the exchange. Now, why would the U.S. Treasury want to fund these exchanges, and what's in it for them? This is where the strategic value of the Iraqi dinar and oil credits comes in. Once the dinar is exchanged and held by the U.S. Treasury, it essentially becomes a unique asset. Banks, acting as intermediaries or brokers, will also earn profits from the exchanges, giving them an incentive to participate in the process. Meanwhile, the Treasury plans to keep a portion of the 30 note as a high-denomination Iraqi dinar bills for interbanking transactions and global trade with Iraq. Holding on to these notes could also serve as a reserve, especially as Iraq's economy is closely tied to its oil resources. The report notes that Iraq has guaranteed oil credits to the U.S. Treasury at a set rate per barrel. This means that rather than repaying the U.S. in cash for the dinars exchanged, Iraq would supply oil at a discounted rate. Sources from the Central Bank of Iraq, CBI, suggest that this credit rate could range from $30 to $35 per barrel. If the global oil price is higher than this fixed rate, the U.S. Treasury could make a significant profit by either using the oil domestically or reselling these oil credits to other countries. This strategy has multiple advantages. First, it helps the U.S. Treasury recover the costs associated with funding the dinar exchange while providing a steady source of income. Furthermore, selling these oil credits to countries that need Iraqi oil opens up new economic and diplomatic opportunities, allowing the U.S. to maintain a profitable relationship with Iraq while enhancing its oil reserves or supplying allied nations. This arrangement reduces Iraq's need to repay large amounts in cash by using its natural reserves as its oil wealth as leverage. In summary, this analysis suggests a potentially beneficial cycle where the U.S. Treasury funds dinar exchanges, banks earn profits as brokers, and Iraq fulfills its side of the exchange using oil credits, reducing its financial burden. This setup could prove to be advantageous for both nations, with the U.S. gaining access to valuable resources and Iraq securing a strong trade partner.